Hello guys, welcome back to the channel. Uh, I thought I'd do a video on the US fixed income market. I saw a really interesting article on Yahoo Finance the other day about the underperformance of the US bond market in the past 3 years, and it is a very important development in the financial market from the past few years. So I thought it's interesting to do a video on this. And So yeah, let's dive in. So I copied this from the article, this chart, right? And they reference this piece of research from the fixed income market from from Bank of America's research team. And so let's look at this chart. So it's basically all the investment returns from U.S. 10-year government bond since the 1700s. Actually, it went back a long way. So basically, it says never in the history of the U.S. Republic have U.S. Treasury returns fallen 3 years in a row, except in the past 3 years. So if you look at the chart, yes, it is most of the time basically returns on US Treasury are positive, and it's never really fallen 3 years in a row for fallen 3 years in a row ever. So what happened in the past, 3 years was quite a historical development. So I'll just read from the summary. So the 10-year US Treasury bond is on track to suffer 3 consecutive years of losses. A back-to-back-to-back slump would represent the longest stretch of losses since 1987, according to Bank of America. The decline comes after U.S. Treasury bonds suffered the worst annual loss since 1788. So basically, the U.S. 10-year Treasury is on track to see its third consecutive annual loss. The 10-year bond fell 3.9% in 2021, tumbled another 17% in 2022, which was its worst annual loss since 1788. So far this year, it's down 0.3%. It says 10-year Treasury on course for third consecutive loss. It has never occurred in 250-year history of U.S. Republic. It reflects a staggering 40% jump in U.S. nominal GDP since 2020 COVID lows. Bank of America investment strategist Michael Harnett said in the Friday note. So it's a pretty historical development how much bonds have really collapsed in prices since COVID. And if you look at the nominal GDP, it's also pretty incredible. It's jumped 40% since the COVID lows. I mean, it kind of makes sense that given the inflation. Well, the nominal GDP is, yeah, it says here, it's basically real growth plus inflation. And given the high level of inflation that we've seen since COVID, uh, it makes sense that bonds have really it's basically collapsed in the sense that it's reflecting much higher risk premium because of the inflation that we're seeing, right? So from Schroders, investors have been investing in cash or cash equivalents due to the historic underperformance of fixed income markets and high yields than certain longer term bonds. However, with an economic downturn expected in 2023 or 2024, we believe adding longer dated bonds to lock in high yields could be a valuable move. Given the historic underperformance of fixed income markets last year and the fact that cash yields more than certain longer term bonds, many investors have invested in cash or cash equivalents. With the consensus outlook of an economic downturn in later 2023 and early 2024, we believe adding longer dated bonds and therefore locking in high yields could prove valuable going forward. We think investors may not fully appreciate the risks of continuing to overweight short-term investments or cash, nor the yield cushion bonds currently offer against for the price declines. Although an allocation to cash for flexibility is prudent, we believe it's time to start thinking longer term. So they think it's time to really buy into the bond market, given how much has come off. I personally think that, and I will come on to that because there's another article that I found about fixed income market outlook. I think that there might be more downside to come. I mean, given there's a few dynamics going here, like how much government bonds they're issuing, the U.S. Treasury is planning on issuing, and also the fact that inflation can stage a comeback. We've had relatively favorable inflation numbers coming in recently. Inflation has come down a lot, but I think the risk that inflation will come back eventually, or that we see some kind of a second wave in inflation cannot be ignored. So yeah, I mean, I think bonds have definitely repriced, but whether it's time to really scale it in a big way is debatable. So here's a chart in 10-year Treasury yield. I mean, I got it from TradingView. I mean, it's pretty incredible, the range, right? If you look at, I mean, this is a really longer data chart. It goes back to 1920s. And if we look at the range, I mean, in the 70s, when the inflation went out of control, interest rates actually went all the way to like almost 16% actually on the 10-year, but not quite, right? But it collapsed all the way to almost zero, and now we're at 4.3, something like that. I mean, can it go higher? For sure, but it's certainly, uh, on a technical basis, perhaps this move is looking a bit stretched, right? But whether it can actually, it is time to scaling, I think this is the big question. Where is it time to buy into bonds? And I got another chart. This is the 10-year expected inflation chart from the Fed's website. So this is basically inflation expectations, which, despite the high inflation that we're seeing, is actually relatively well anchored. Right? If you look at the numbers, it's been around something like 2.129 actually here. So that's here, the latest estimate of expected inflation. So it's still relatively well anchored. It's pretty close to the Fed's 2% inflation target. So, I mean, which is definitely a positive. But the question, would it remain anchored, or would it start to go out of control if we see a second wave of inflation, right? And then the next chart is the term premium. On a 10-year zero coupon bond, I got this from the Fed's website as well. So exactly what term, I'm not going to go in depth into what the technical definition of a term premium is, but you can think of it as a risk premium on bonds, right? How much is paying you to compensate you for effectively interest rate risk. So the term premium, if you look at actually the history of term, according to this model, the Fed's model, the Fed's estimate of term premium of 10-year zero coupon bond, I mean, in the 90s it was something like 2%, right? It went to above 2.5%, and then it's been trending lower and lower. And when COVID happened, it was basically negative, and now we are kind of around zero. So that's definitely room for it to go higher, right? Looking at this chart, I mean, it's certainly room for it to go higher. I mean, term premium, you expect term premium to go up if investors are not sure about whether inflation is well anchored, right? Intuitively, I would think, because it's there to compensate you for the interest rate risk. So if inflation is not well anchored, there's a risk that interest rate can go much higher, right? So makes sense that term premium on bonds would be higher if investors' expectations of inflation is not well anchored. So I think this is really what would move the bond market going forward. I mean, because you look at it hasn't really repriced much, right? It's gone from -1 to almost zero, but historically it's normally a positive number, right? It's most of the time actually it's been positive. It's still slightly negative or effectively zero. So I think that there's room for certainly for term premium to go up. So I wouldn't be too bullish on bonds right here, given all the dynamics that I've been kind of talking about. The inflation can come back, and term premium can go back up. I think for bond investors, they can probably still wait a little bit. So how are term premiums defined? So it's a long passage I got from the Fed's website. Right? Effectively, it compensates. It's a risk premium, which basically compensates bond investors for interest rate risk, effectively. So most of the time, as you see from the chart, it's a positive number, but it's still around zero, which is still relatively low relative to history. So I think there's certainly room for it to go much higher. This is the core PCE chart from the Fed's website. As you can see, from after COVID, it's with the bulk of inflation that we've been seeing, it's exploded, right? But now it's kind of trending down at 3.7%. But the question, would it ever go back to 2%, right? The Fed's target is 2%. Do you think they will go back to 2%? I'm not quite sure. Yeah, I think it's really the big question. And what if we don't ever go back to 2%? What would the Fed continue to hike and push us into some kind of a recession? So this is another article I found from Business Insiders and about the bond market, and it references this interview that Larry Summers actually did with Bloomberg earlier. So So he's very logical, right? He basically sort of broke down the pricing of bonds into three main factors, right? So if you look at this, it says he offered an interesting breakdown of the 10-year yields into three components. So the first component is inflation, right? He predicts will rise faster than before, possibly at 2.5%. So I kind of agree with him. I don't think we go back to 2% inflation for a very long time. Then the second component is the real return. So it's basically real interest rate, how much you're actually getting paid above inflation. So he thinks that the real return should really be 1.5 to 2%. It's influenced by the government's growing borrowing needs. Yes, the Treasury is issuing a lot of bonds. This includes factors like increased defense expenditures, potential extension of some tax cuts from the Trump era, and rising interest costs on existing debt. And then the third one, which is what I was talking about, is the term premium, which compensates investors for choosing long-term securities over short-term ones. Some estimates this to be between 0.75 to 1%. So I think that this is about right? When I think about where 10-year yield should be. Uh, so, if you look at, so he thinks that the term premium it's somewhere between should be somewhere between 0.75 to 1%. So if you look at the chart that I downloaded, this historical chart on the term premium, I mean, it was as high as 2% in the 90s, right? And then it trended lower. So somewhere between 75 basis point and 100 basis point is probably correct, right? So if you believe him, he thinks that investor might be eyeing a 4.75% yield or higher on a 10-year in the upcoming decade. Yep. Find it. I think I kind of agree with him. I don't think that bond yields will come back down in a hurry. So for those of you who are looking to, buy bonds or fixed income securities, I think you can wait a little bit and maybe start scaling in instead of going in a big way, putting too much money in it. It's probably better to scale in. Yeah. So what do you guys think? I mean, I find this to be pretty fascinating. I mean, I did a video on UK inflation, as you can see on my channel earlier, and I think that this is kind of an extension of that to look at the bond market. And bonds have had a huge move, right? If you look at the article that I was referencing earlier, like it's collapsed 3 years in a row. But is it time to buy yet? I mean, is it looking cheap? Is it time to buy yet? I mean, it is certainly potentially looking cheap, right? But I personally think that it can go more, given all the sort of geopolitical headwinds and macroeconomic headwinds on inflation and growth. I think that bonds can probably derate a little bit more. And yeah, it'll be interesting to see how it develops from here. Thank you for watching my video, and don't forget to subscribe. I will talk to you more. Thank you.